The IRS just released the official 2026 tax brackets, and buried in the announcement are 3 strategies that could save you over $50,000 this year. $50,000, but here is what nobody is talking about. 2 of these strategies are temporary and disappear after 2029. That is just 4 years to maximize these benefits, and most taxpayers have no idea they even exist. Look, I know how you feel about taxes. Every year, it is the same story. Fill out the forms, watch your hard-earned money disappear, and wonder if you are missing something the wealthy know about. Meanwhile, you read about billionaires paying less in taxes than their assistants, and it feels completely unfair. But here is what makes 2026 different. The IRS just gave you 3 legitimate tools that wealthy people have been using for years, and I am going to show you exactly how they work. Before we dive in, let me tell you why 2026 is so critical. 3 major tax changes are converging at the same time. First, bonus depreciation is dropping from 60% in 2025 to just 40% in 2026. Then it goes to 20% in 2027 and disappears completely in 2028. Second, many provisions from the 2017 Tax Cuts and Jobs Act expire after 2025, which means 2026 through 2029 are your last years to maximize certain benefits. And third, the massive $15 million estate tax exclusion was legislatively increased for 2026, but nobody knows how long it will last. This is not just another tax year, this is a rare convergence of opportunity that will not happen again. All right, let us get into the 3 secrets. Secret number 1 is depreciation front-loading. Now, if you own a business or rental property, this strategy could save you tens of thousands of dollars in 2026. Here is how it works. Normally, when you buy business equipment or property, you deduct the cost slowly over many years. A piece of machinery might take 7 years. A building might take 27 years. But the IRS allows you to accelerate those deductions using 2 powerful tools: bonus depreciation and Section 179 expensing. Let me give you a specific example. Imagine you own a small manufacturing business, and in 2026 you buy $300,000 worth of new equipment. With 40% bonus depreciation, you can immediately deduct $120,000 in year 1. That is 40% of $300,000. If you are in the 32% tax bracket, that $120,000 deduction saves you $38,400 in federal taxes in the first year alone. $38,400. Let me say that again. $38,400 in tax savings from one equipment purchase. But here is the critical part. Bonus depreciation is dropping every single year. It is 40% in 2026, 20% in 2027, and 0 in 2028. If you wait until 2028 to buy that same $300,000 in equipment, you get 0 bonus depreciation. 0. That is why wealthy business owners are front-loading their equipment purchases right now in 2026. They are getting the 40% deduction while it still exists. Now you can combine bonus depreciation with Section 179 expensing for even bigger savings. Section 179 lets you deduct up to $1.22 million of equipment purchases in 2026. $1.22 million, and here is the advanced move that real estate investors use. It is called cost segregation. When you buy rental property, normally you depreciate the building over 27.5 years. But cost segregation lets you reclassify parts of the building as personal property that qualifies for bonus depreciation. Things like appliances, flooring, lighting, landscaping. Suddenly, instead of waiting 27 years for deductions, you are getting 40% of those costs deducted in year 1. Let me move to secret number 2, capital gains harvesting. This one is huge for investors and almost nobody talks about it. For 2026, married couples filing jointly can have up to $98,900 in long-term capital gains and pay 0 federal tax. 0. Single filers get up to $49,450 at 0%. Here is how wealthy investors use this. Let us say you are a retired couple with $60,000 in taxable income after your deductions. You have $80,000 in stock that has gone up in value. You have held it for over a year, so it qualifies as long-term capital gains. You sell the stock and realize $80,000 in gains. Your total income is now $60,000 in regular income plus $80,000 in gains, which equals $140,000 total. But here is the magic. Because your regular taxable income is only $60,000, and that is below the $98,900 threshold, you can add $38,900 in capital gains at 0% tax. The remaining $41,100 in gains is taxed at 15%, which is $6,165. Compare that to if it was ordinary income. $80,000 in the 22% bracket would cost you $17,600. You just saved $11,435 by structuring it as capital gains. Over 4 years, that is $45,740 in savings. Now pay close attention to this next part. This is critical. Wealthy investors use a strategy called tax gain harvesting. It sounds backwards, but here is how it works. If you are in that 0% capital gains bracket, you intentionally sell appreciated stocks, pay zero tax on the gains, then immediately buy the same stocks back. Why would you do this? Because now your cost basis is higher. When you eventually sell in the future at a higher tax bracket, you have less taxable gain. You essentially locked in a 0% tax rate on that appreciation forever. This is completely legal, and it is the opposite of tax loss harvesting that most people know about. All right, secret number 3, estate tax planning with the $15 million exclusion. This one is massive, and most people think it does not apply to them. But listen closely. For 2026, the IRS increased the estate tax exclusion to $15 million per person. For married couples, that is $30 million combined. This is not just an inflation adjustment. Congress legislatively increased this amount, but here is the catch. Nobody knows how long this will last. It could be reduced in future years. You might think this does not apply to you, but listen, a home, retirement accounts, life insurance, and a business can add up faster than you realize. Wealthy families are setting up trusts and making large gifts now to lock in this $15 million exclusion before it drops. Gift appreciated property to your kids today, and all future appreciation is out of your taxable estate forever. And here's the really powerful part. Let us say you have a rental property worth $1 million that you bought for $200,000. If you die and leave it to your kids, they get a step up in basis to $1 million. But if you think the property will be worth $5 million in 20 years, and you are worried about future estate tax changes, you could gift it now using your $15 million exclusion. That property and all $4 million of future appreciation is now out of your estate, and you used only $1 million of your $15 million lifetime exclusion. This is exactly what ultra-wealthy families have been doing for decades. Now the exclusion is high enough that upper middle-class families can use the same strategies. Now, before you implement any of these strategies, let me tell you the 3 biggest mistakes that cost people thousands of dollars. Mistake number 1, buying equipment just for the tax deduction. The tail should never wag the dog. Only buy equipment your business actually needs. A 40% deduction means you are still spending 60% of real money. Do not let the tax tail wag the business dog. Mistake number 2, harvesting capital gains without considering state taxes. Remember, we have been talking about federal tax. If you live in California, New York, or another high-tax state, you might still owe significant state capital gains tax even if your federal rate is 0%. Always run the numbers for your specific situation. Mistake number 3, and this is huge, waiting until December to think about these strategies. By the time December rolls around, you have limited options. Equipment might not be available. Estate planning attorneys are booked solid. Investment rebalancing could be rushed. Start planning now. If you want to use bonus depreciation, start identifying equipment purchases now so you can execute before December 31st. If you are considering estate planning, meet with an attorney in the next 60 days, not in December. These are time-sensitive opportunities, and proper planning takes time. All right, let me recap the 5 key points you need to remember for 2026. Number 1, bonus depreciation is 40% in 2026, but it drops to 20% in 2027 and disappears completely in 2028. Front-load equipment purchases now. Number 2, married couples can have $98,900 in long-term capital gains at 0% federal tax. Use tax gain harvesting to lock in 0% rates. Number 3, the estate tax exclusion is $15 million per person, $30 million for couples. This is a legislative increase that might not last forever. Number 4, these are not set-it-and-forget-it strategies. They require proper documentation, professional guidance, and careful planning. Number 5, do not wait until December. Start planning your 2026 tax strategy right now. Now, here's exactly what you need to do. First, if this video will save you money, hit subscribe and turn on notifications. I release tax-saving strategies every week based on official IRS guidance. These are the same strategies wealthy families pay $50,000 per year for. Second, share this video with one person who needs these strategies. A business owner, retiree, or someone planning their estate. You could save them tens of thousands with one text. Third, comment below which strategy will save you the most money. Are you a business owner ready to use that 40% bonus depreciation? Are you an investor who can take advantage of the 0% capital gains rate? Or are you focused on estate planning with the $15 million exclusion? I read every single comment and I love hearing about your wins and your specific situations. Your comments also help other viewers learn from real examples. Fourth, this is critical. Consult with a qualified CPA, enrolled agent, or tax attorney before implementing any of these strategies. These strategies work, but they require proper documentation and professional execution. Improper implementation can lead to disallowed deductions and IRS penalties. Spend a few $100s on professional advice to save thousands in taxes and avoid costly mistakes. These are real opportunities to keep more of your hard-earned money and build wealth faster. 2026 gives you a rare window where three powerful strategies align: 40% bonus depreciation, 0% capital gains, and $15 million estate exclusion. But these are temporary. Every year you wait costs tens of thousands of dollars. The wealthy plan years in advance. They max out every legitimate deduction, and now you know their secrets. Thank you so much for watching. Remember, this information is based on official IRS Revenue Procedure 2025-32, published October 9th, 2025. Tax laws change frequently, so always verify current rules and work with qualified professionals. I will see you in the next video where I will break down even more tax-saving strategies for 2026. Until then, start planning, stay informed, and keep more of what you earn.